everyone. I'm super excited to welcome my today's guest. We have someone who has always followed a non-traditional journey to success, from freshman at USC to starting his own startup, Gumroad, to now becoming an unconventional venture capitalist by investing from his rolling fund. So super excited to welcome him today. Welcome to Shl.vc. I'm your founder and host, Gayatri Sarkar. So today we have Sahil Levechin. He's starting his rolling fund and he's also the founder of Gumroad. So super excited to welcome you, Sahil, here.
Thank you for having me.
Yeah, so I have got so many requests to have you. So I was like, okay, I need to get Sahil on Shl.vc to have him over here and talk to him. I mean, you have been, you have traveled an amazing journey. You have been an employee number 2 at Pinterest, founder of Gumroad, followed the dropout kid path of Zuckerberg, Gates, Jobs, and now you are one of the most talked about rolling fund VC. So where do you find yourself on your expectations?
Nowhere close, honestly. Yeah, I realized, I don't know, maybe several years ago now, I guess, that expectations are not super useful. Either you surpass them or you don't, but in general, I find that life kind of tells you what to do. And I found that like the less kind of expectations I have for myself, the more open I get to be about what I get to do, what I get to say yes to. A lot of Pinterest and Gumroad and the rolling fund now, like they were, I think they happened because I was open to the idea. It wasn't me saying, I want to take this path in my life. I think that's virtually impossible. COVID, I think, hopefully shows that point more than anything, that you can plan as much as you want, but ultimately a lot of stuff, just kind of out of your control. All you can do is, I feel like, react to the present moment and, do as best you can, sort of given the circumstances, given that, the kind of the hand that you have, I guess.
I love that answer. So you don't have any vision board and all this thing that a lot of people are, power of manifestation. I would love to.
Not anymore.
Yeah.
Not anymore.
So you have raised $10 million from Kleiner Perkins, Lowercase Capital, first round, Sacca, Naval, Max. I mean, these are big names. So why did you decide to be on the other side of the table and write checks for founders?
Yeah, I mean, it really happened organically. I started angel investing at first. I did my first few in 2011. So while I was at Pinterest, I basically had some money saved up to go to college. And then when I dropped out, I still had that money, right? So I was like, I can invest this, it's like $45,000. I can invest this into a few startups, not that many. That's not a huge chunk of change. But I can do, pick 4 or 5 companies and start learning. That was the goal, right? Like most people, I remember at the time, everyone was like, you need to do a bunch of investments for this to make sense because so many of them fail and you need to hit that unicorn, et cetera. This is before, I guess, the unicorn nomenclature, but before you hit the big winner, which I think is actually wrong, but we can get into that later. So yeah, it was mostly just for me to learn and sort of like figure out, like, if I ever intended to start a company, it would be good to have the context of the investor, because ultimately as a founder, that's one segment of your customer base is the investors that you bring on board that you hope to return capital for. You have a lot of different kind of customers as a founder. But that was sort of did that in 2011, and then I did a bunch more recently after one of those from 2011. HelloSign sold to Dropbox. I sort of had a big liquidity event from that relative to anything else I've ever had in my life. And so I was like, I'm just gonna, now I can do, a bunch more. So I just redeployed that into a bunch of startups. And after the George Floyd stuff, I tweeted out, I'm looking to invest in Black founders. Ended up investing in 6 so far this year, maybe 7. Wow. Just from, a tweet or two. This is the power of Twitter. These people were not in my network, but I could just broadcast this and they could come to me. And, obviously there's some work there to filter through hundreds of emails and have I had like 40, 50 meetings or something like that. But with Zoom and, the remote, like I really do think it kind of makes the world a lot smaller
Yeah.
in a really great way. And so I did a few of those, and then I basically, some of them were looking for more money. So I said, hey, Naval and Max and some of the other folks that I've met over the years, like these companies that I invested in are looking for some more capital. And Naval was the one who suggested, like, have you ever thought about starting a fund? I would love to be an anchor in your fund and help you kind of fundraise, and then, and you can see what happens. And sort of that coincided sort of really nicely with rolling funds, and sort of really lowered the barrier to entry for me. Because I would, full-time founder CEO, I would not really consider myself a VC. I would not sort of say, hey, I'm going to take 9 months or 12 months or 18 months and go raise a $10-15 million traditional fund. And so that was the start of it, was really Naval saying, hey, have you thought about doing this? And, the hardest part is getting the first yes, right? Regardless of your first job, your first angel check as a founder, your first anchor LP as a VC. And so when Naval was like, hey, I can do this, I pinged a few other folks, got some good interest early, and I was like, okay, I think there's something here. So the market wants this,
Yeah.
And then sort of that's how that kind of journey began.
Yeah, you almost answered my next question. Like, what is the barrier to entry for starting a traditional fund for someone like you? But as I said, like, everyone at Sandhill. I mean, Naval is your anchor LP. So, but you took VC as a relationship-based industry, and now you're targeting like a rolling fund. So, if you can explain what is a rolling fund and how do you think like this looks like in the future, but especially with emerging fund managers like you.
Yeah, I mean, this is one of the critiques that I think rolling funds get is, or maybe not critiques, but I think some of the pushback potentially is like, look, you could have raised a traditional fund. Someone like me, someone like Naval, whatever, like we're all connected. But that is how these things start, is like you end up with people who actually could have done the traditional thing. They're going to embrace the new model. And then that kind of opens up the door. It gets kind of popularized. And then it takes time to get to the really new people who wouldn't have done the old thing before. I saw this with Gumroad. Gumroad is sort of a similar thing where we democratized this ability. And it was all these people who were already selling online that were now doing it in a new way. And then it's the people who were like, had never sold online that were like, oh, I see all these people, I should do this, right? So I think I think some people are, judging a little bit too quickly. It's like saying remote work doesn't work. I'm like, well, it's been 3 months or 6 months. Like, it takes time to figure these things out. So I would say that. I mean, in terms of the mechanics, basically the way a rolling fund works is it's not that different from a traditional fund. I think there's 3 things that are really interesting about it to me. One is the fact that I can raise money on an ongoing basis. So, for example, people listening to this call can DM me on Twitter. This is totally real. Some people really don't believe this, so I have to like really clarify this. Like, you can DM me on Twitter. I can give you a memo that sort of, just like you would get a pitch from a traditional VC. And then I can give you, if you're in, I can give you an angel list link, and you can literally sign up. You can wire me the money, and then I can give that money to a startup within a week, within 48 hours,
Wow.
which is that feedback loop is pretty unfamiliar in VC, right? It's, you like, I already have my fund 1, come back, fund 2 will be 3 years from now, like, come back, then I can add you to an email list and I'll let you know how things go or whatever. And there are these big check sizes and it's this big ordeal. Whereas like with me, I can kind of collect 50K, 100K, 200K checks along the way. Which has a bunch of other great benefits. But I think one is that, right? The feedback loop. So it means you can start really small because I can always up it per quarter. It's not like, oh, I raised $1 million, I have to finish that, and then I can go raise 5. Which kind of, I can sort of graduate. Like, I started the fund at 100K a quarter. I ended up getting to around 4 million a quarter the week before the launch. And then I had to email or DM the TechRun reporter being like, oh, by the way, it's now 5 million. And then now it's 6.6 or $7 million. So it's like, it's constantly growing, which is kind of an interesting idea, I think, in itself. So that's one thing. And the other thing is that it's open. It falls under the 506C regulations. This is possible for traditional funds, but again, like with a traditional fund, when it's not as useful because you're not collecting capital on an ongoing basis. So like, there's not as much of a value to sharing it as openly. And but that is sort of, it fits really nicely into the sort of quarterly rolling idea. And then the third thing I would say is that it's just incredibly scalable. It's softwareized, right? Software is eating the world. This is sort of software eating the traditional venture fund. I can do a deal. It takes me around 2 minutes. There's a video that I recorded of me doing a deal end to end, wiring the money and everything. And so like I could literally do 100 deals a quarter if I needed to, because the bottleneck of the people in the process is gone. It's all basically automated, or I don't know if it's automated, but it feels automated to me, right? AngelList might be doing some stuff on their end, but I could do 100 deals a day potentially. Why not, right? I'm not currently doing that, but it certainly makes it easier as a founder CEO to know that my sort of my committed time to this thing is virtually nothing besides meeting with founders, deciding to invest, which is, an hour, 2 hours per $100,000 check. Like that's an incredibly efficient time spend. Versus, maybe with a traditional fund, there's time spent doing other things. I met a VC the other day who's incredibly successful, one of the top tier seed funds. She says she spends around 75% of her time on the VC side of things, on the LP side. I spend the equivalent of 0% of my time. So already from the get-go, I'm 4x how much time I can spend meeting founders, doing diligence, helping my portfolio, building my brand, like these things that are actually creating value. Not to say that other stuff isn't useful, but I can basically do a webinar and thousands of people will see it, and I'll get millions of dollars per year in capital to committed capital versus, hundreds of meetings. And obviously with COVID, that's, no more planes, no more Ubers, no more Sandhill Road, right? And all of that time.
And you can be anywhere.
Yeah, I could, you have no idea where I am. I'm just a head on a screen, right? And that's really, really cool. So I think that also dovetails really nicely with like enabling this new model, kind of coincidentally almost.
I love that. I love the fact that you are becoming a true VC instead of focusing on the frictions. It's taking away all the frictions and you're focusing on investments, due diligence, and rolling up your sleeves with your startups. And you touched based a little bit about the legal aspect. I would love to know, like, especially, how SEC rules play in effect. How does it work in rolling fund, considering, many of you are vocal about raising raising money from LPs, and especially we are talking right now, hey, you can just DM me on my Twitter. I would love to know your take on that.
Yeah, so traditionally funds fall into a designation called 506B, which means you can't generally solicit, right? That's sort of the words that people are familiar with. So when I first started talking about the fund, before I launched it, I said, hey, I'm thinking about raising a fund. I got 10 to 20 DMs, texts from VCs. Some people I'd never even met who were like, you cannot do this. You can't say this stuff. You're going to, this is illegal effectively. And I would be like, no, it's not illegal. It's actually, I just happen to know the regulations that you're bound to better than you do, which is, a little bit maybe mean of me or something. But like the truth is they're new regulations. VCs have been told by lawyers for a long period of time that they can't do this thing. So when they see someone do this, their instinct is like, this is wrong, right? Yeah. I was told I can't do this, so therefore this person can't do it either. But basically the background of it is there's the Jobs Act in 2012, 2013 that went live, which enabled crowdfunding for equity and a lot of other stuff. But to do crowdfunding for equity, you also have to tell people, right? You can't really crowdfund for equity with it. So it's sort of like reinvigorated a lot of the legislation around private equity. And part of that back in 2012, 2013, when that went sort of official, was the 506C sort of new clause. It just turns out that because of what we were talking about before, traditional funds didn't really embrace it because, if you're dealing with family offices and stuff, you're not raising through Twitter, right? That's not that compelling to people.
Yeah.
Right? If you told Sequoia, hey, you can go raise from people on Twitter, they'd be like, well, no, we want to raise from Harvard, right? And so I think it took like a new generation of kind of sort of people like me who have built audiences on Twitter and on other platforms to kind of see the value, I think, of that. And even AngelList, frankly, I don't think saw the value of 506C. It was an option. And when I was talking to them, they said, hey, do you want to do a 506C? And I said, what does that get me? And they're like, well, it means you can go on Twitter and fundraise. I'm like, duh. Like, why? And now it's no longer an option because I think they've realized like, wow, how big of a deal that can be. And so, yeah, so that's kind of the background. And really a rolling fund, I think a lot of people, they get really caught up in it. I think there are a lot of people who are saying there are downsides to rolling funds. There's this con. There are 0 cons to rolling funds because you can take a rolling fund and turn it into a traditional fund if you want to. You can say, hey, we're only raising capital every 3 years. You can say, hey, every single person who commits to this fund has to have, has to be a $250,000 check. You can decide not to do 506c. You can say, I don't want to tell anyone about it. So you can do everything. There's nothing worse about a traditional fund, in my opinion. If you are about a rolling fund, you can sort of turn it into a traditional fund if you want to. So I think that's kind of a misconception. There's literally nothing worse about it. People say, hey, like, I don't like the idea that people can sign up quarterly because, like, what if there's a recession and LPs leave? And I'm like, well, you can prevent that. You can just have a minimum. I have a minimum on my fund. So no one can sign up for 1 quarter on my fund. I would not recommend that to anybody because I think time diversification is an important attribute of a fund, right? So, mine is 4 quarters. A lot of people have signed up for 8 quarters. You can say it's 3 years. You can do whatever you want because it's all software. You can set the rules however you want. You don't have to talk to a lawyer, etc. But effectively, a rolling fund is basically a set of SPVs. So every quarter, a new SPV is spun up. Everyone who has a quarterly subscription to your fund gets the money pulled into AngelList, and then AngelList sort of holds it in escrow for that quarter. And then I invest out of that quarterly SPV, or they do on my behalf. I kind of tell them to, and then they do all the math in terms of distributions and carrying out the carry and all of that kind of stuff, the K1s, et cetera, et cetera. So it is actually a set of traditional funds. Effectively, it's just a new fund is spun up every quarter, and all of that has been sort of operationalized, so I don't have to think about any of that stuff. And explaining that would be complicated, so we just say it's a rolling fund, right? But that's what it sort of is in practice. Is a set of 4 SPVs per year.
That's great. Actually, it's still a 2 and 20 fund. So are you able to change the 220 to like 2.520, something like that?
Totally. Yeah. And they actually recommended I sort of charge more, but again, like a lot of these first time funds, they have to start with 2.5 because you don't have scale yet, right? And you need to pay yourself a salary, but I have a full-time job. I pay myself a yearly salary from Gumroad. And so mine is 220. But again, does 220 make sense? No, like it doesn't make sense. It should be lower or higher. The chance that it should be 220 is for like the vast majority of firms is 0. Like that makes no sense. That's a good example of the fact that it's not a free market. It might be 1.9, it might be 2.8, like who knows where that ends up. And my belief is that this stuff will get more liquid over time. And frankly, that my management fee will probably go down and my carry will probably go up because I want to be as aligned as possible on that side. I sort of suspect that over time I will take as close to a 0% management fee as possible. Which guess what? That's going to scare a lot of VCs. When I start going in, I mean, I would do it today. If someone says, hey, I want to give you $5 million, I would 100% say, I will literally charge you a 0% management fee or effectively a 0% management fee. Because I don't want to make money on this if you don't, so I think there's a lot of things. I can set them to whatever I want. I chose 220 because I knew I was sort of early and I wanted it to be as close to a traditional fund as possible because I want to kind of bridge the gap for people. But once people are on the other side of it, I think people will start to experiment more with what you can do there. But yeah, you can set it to 220 or you can have hurdles above, a 3x return. You could do 2.5, you can do 1.5, et cetera, et cetera. You could do 70, 0.75, whatever you want, really.
I love this. This is great. I mean, I love the fact that you're talking about the free market theory, and and you touched a little bit on the liquidity side. I would love to know a little bit more about the LP liquidity and also the time diversification you talked about in a rolling fund. And what's your take on that?
Yeah, so the way that I thought about it was, a traditional fund is deploys capital over, let's say, 2 to 3 years. It used to be longer, but it's kind of gotten compressed over time. So you could sort of critique all funds for this. I think there are a lot of early stage funds that raise money and then they deploy it in like 12 months, 18 months, because maybe the GPs are maybe a little bit too excited. you know, especially if you're a founder, right, you see all these companies and you're like, I want to help all these companies. And then 3 months in, you're like, wow, I can't do this. There's way too many cool companies to actually, we have to be a little bit pickier. Unfortunately, you know, I would love a lot more money so I could give it to a lot more companies. But yeah, so I, you know, again, like this has nothing to do with rolling funds, right? This is just a strategy on the GP side. But yeah, I thought about it a lot. I have great sort of Series A. I have Josh Koppelman who started first round. I have John Lilly, who was at Greylock. I have Hunter Walk. I have some great GPs. I have people from the top, you know, a lot of the top tier firms, Andreessen and all those folks. So I have a lot of people I can ask, right? And so what I decided to do was like, I'm going to model it off of like a 3-year, 4-year fund. So it's $7 million a year, $6-7 million a year now, which is effectively 24 to you know plus $1 million fund. And I'm going to try to sort of be diligent about it and say I'm only going to deploy. You know, I'm thinking about it like a 2 to 3 year thing. So if you as an LP want to commit to this thing, you should think about it like an 8 quarter or 2 year or a more thing, right? But it's really just about managing expectations, right? This is the other thing I think sometimes the discourse misses is the people that are like, hey, you know, this doesn't favor LPs, or like LPs are getting a bad deal because they're not getting enough this, and this. And I'm always like, here's a list of my LPs. They know this stuff. You know, like, you know, they're pretty savvy. They're better investors than many of these people who are critiquing from the sidelines. So like ultimately it's their choice, right? I can say what the deal is and they can say yes or no. No one I think is sort of under any illusion, you know, besides what I've presented. And again, it's a free market, right? So it's you know, people can always decide to opt in or opt out, and that's great. But yeah, that's kind of how I think about it. Is like, you know, 2 to 3 year deployment cycle. But it is ongoing. It is kind of evergreen in that sense, where the fund is effectively just going to continue to grow over time. As both my existing LP base sort of gets more comfortable and starts upping their commits, which is already happening, like 3 or 4 weeks in, it's starting to happen already, because people are starting to already see like how much traction I'm getting on with founders and getting into deals and things like that. A lot of people are sort of starting with the lowest that they feel comfortable with, and as they get comfortable, I think they'll go up. And then there's obviously new folks all the time, because I can continuously talk about this thing. I'm constantly sort of getting inbound. Every week I'm adding people into the fund, you know, and I can continue to do that sort of indefinitely. So yeah, so that's kind of how I think about it. It's just like any GP, right? Like they're bad ones, they're good ones. You should do the work and make sure that you have a good strategy and talk to people who've done it before. And I think I've done that pretty well.
You know, that's amazing. Do you see institutional LPs also investing in rolling funds? And I would love to know, what's your advice to them, you know, when they're always shaky investing in first-time fund managers?
Yeah. So there's two things at play, right? There's that, as you mentioned, there's this sort of just the idea that they're first time. So that makes it hard anyways. And then there's the fact that there's this kind of new legal paradigm. I think I basically said I'm not talking to any institutional LPs. If they want to talk to me, I'm happy to sort of talk to them back and educate them on this thing and teach them and things like that, because I enjoy meeting people. That's part of why I wanted to do this, is it gives me an excuse to meet cool people. But like, I'm not trying to sell this to anyone, right? So if people say, hey, I don't want to do this, I'm like, yeah, that's fine. I have a waiting list of 15, 20 people who want to get into this fund. Like I'm not in a rush to fill any seats or anything like that. In terms of institutionals, I have one institutional investor who is in the fund already.
Wow.
I'm talking to a few more. They're still relatively small checks, so I think that was 200,000 for the year, so it'd be 400,000, 600,000 over a couple years, 3 years. And then I'm talking to others as they start to come in. They're seeing it in different places. Maybe this podcast people will reach out, etc. So like, but it's still early, you know. And the other thing is, like, ultimately, like a lot of these folks, like, they want a track record. This is the same for traditional funds, rolling funds, whatever kind of thing, right? And so I'm not saying like, oh, I need a $20-30 million fund, and that's going to require these institutional LPs. I'm like, look, I'm very happy. I don't have expectations, as I mentioned, right? I'm very happy with the fund size. It's way larger than I ever thought it would be, even 2 months ago when I had the idea, or when Naval gave me the idea. so I'm just having fun. I think it's, I'm very happy with 6 million a year. If someone said, hey, I want to give you 10 million a year, I'd be like, awesome. If someone said, I want to give you 50, I'd probably have to reconsider some stuff before I said yes. But yeah, I think it's, I think institutional LPs will jump on board. They just need more data, right? They just need to see that it works. They need to see that it's, other folks are jumping on board. Someone I saw on Twitter said, we don't want to be first. We want to be we want to be a really close second. So I think it'll take a year or two, but that's fine. I think, I'm not in a rush to make this work. This is a long-term game. I'm going to be investing with this fund for the next 50 years. I don't have any intention of, this is not a 2-year thing for me. This is the rest of my life, which is one of the beauties of rolling funds is like, I never have to fundraise again. I'm done.
Yes.
For the rest of my life. I'm done fundraising in that way, And so, yeah, I'm totally patient. So I'm very happy to build relationships with people. And the truth is, and this is part of the diversity stuff that I'm sure we'll get into, but ultimately it is a relationships game, right? A lot of my LPs I've known for 8, 9+ years. A lot of them are investors in Gumroad, or, if you're giving someone a bunch of money and they can kind of do whatever they want with it, you kind of want to know the person. So it does take time to build these relationships. And I frankly don't have any institutional LPs that I've known for that long, So it's going to take time. I can starting to build those relationships now, but it's going to take some time to sort of get to the place where they feel comfortable, giving somebody else's money to me to invest, right? So yeah, I totally understand that.
No, that's great. We have our audiences who are institutional LPs and family offices who will be listening to this. And I think it will be a very interesting take because you're one of the outlier in the traditional venture capital industry and it needs a movement. And I think this is a great movement. I cannot resist myself asking this question that when somebody says that, okay, I'm going to give you a $5 million, they become maybe 50%, 60% or 80, 90% of your fund. And traditional VCs like us, they will be like, oh, okay, that's scary, how much control that LP has. I would love to know your take on that.
Yeah, I mean, one of the nice things about my fund right now is the largest check is sort of that one institutional LP I mentioned, which is, something like 200,000 a year, which is, I have a $6 million fund. So that's literally, 3.3% of the whole fund. So that's really nice because I really feel like I'm not beholden to anyone. Right? I don't have to do anything they say. I don't have to give them any sort of secret information from the companies. I don't have to have a phone call with them every 2 weeks or whatever it might be, right? That some of these LP relationships might mandate. For a $5 million check, I would reconsider that potentially, but it would have to be a partner that I really want to work with and potentially a partner that my founders would get excited about, right? Because if it's a relationship like that, it becomes more of a partnership. But yeah, well, it really depends. It really depends on who that institutional LP might be. And I don't think I would be super comfortable with something like, it's such a big percentage of the fund size, right? It would have to be probably, I would even tell them if someone said, hey, I want to give you 5 million, I'd probably say, let's start at 250 a quarter. Let's start at $1 million a year. That's sort of 20% or less, 15% of the fund size. Which actually, kind of correlates a little bit with how you think about when I raise money and when founders raise money, how they think about the round, right? Because if you raise $1 million round, you can raise it from one person, but that's a little risky. That gives you some signaling problems potentially later down the road, especially if it's a multi-stage fund. So there are actually a lot of similarities that I feel like a lot of people are like, if you're new at this, you should slow down. I'm like, I am new at this, but I've also raised money from VCs and it's not that different. It really is not. It's a similar, even the 20%, right? Like roughly you dilute yourself 20%, 20% carry. There are a lot of similarities that I feel like are popping up that I'm kind of noticing. But that's kind of how I think about it. So maybe 20%, I could say, I feel comfortable with having one LP at that size. But it would definitely change things, so I would want to be upfront about that and maybe even go on Twitter and say, this is happening. This is why I think it's a good idea, because that's kind of my brand. And if I don't feel comfortable doing that, it might signal that maybe I shouldn't be taking the money.
Yeah. And you can take $5 million at a stretch of 20 years, so it's like they will be like a part of the bucket. So that's a beauty of the rolling fund, that you can divide it with, time diversification, however you want to do it. I love that fact. So since you are here and you're the founder of Gumroad, I have to ask you product architecture question. So you're now a VC on the other side. So what's your take on startup performance data? And as a VC, you want to track that early stage company where you're investing, what's their startup performance data, and what's your plan, how you want to do that? I always wanted to ask this question to a lot of founders like you.
Yeah, I mean, I think VCs should be looking at the company the same way the founders are looking at the company, and the same way the early employees and later employees are looking at the company, which is to figure out like what is the metric here, like what matters, um, and like make it really obvious, make it really clear, um, and just be upfront and transparent about it, right? Like for example with Gumroad, we very sort of like very I don't know, we're very diligent about tracking basically how much revenue, how much volume is going through the platform, how many creators are getting paid, and how much revenue we're doing as a result of that net revenue to the company. So for example, last month we were at 12.5 I think million in transactional volume, 18,000 creators and 750 or so, maybe more, 830, 13 or something thousand in revenue. So around 9.8 ARR if you wanted to annualize it. Not really ARR, but you know what I mean. And so, yeah, even just being able to say that, right? I have like a really good grasp on the business. And I think that a lot of the VCs are kind of sometimes they're like, well, that's pretty impressive. How do you know that? I'm like, well, it's, that's my job. Like that's, and so basically I want to be able to do that for all of the companies. So if I can figure out like, what is that kind of sentence or two that I can say, hey, this is the company, this is what matters to that company, and this is where they're at in regards to that. And you don't have to do that much more. I think I often see when founders and other folks have these big long monthly updates, it's kind of a sign that they're maybe not as happy or proud about that number, and so they're trying to like say, oh, they're kind of hedge their bet a little bit, just explain it. And the truth is, honestly, you should just say, we're not doing great and we're struggling, because then I can help hopefully, and we can try to sit down and figure that out. But if I really think you can keep it simple, and you should keep it simple. And ultimately, at the end of the day, I like to say everything except revenue and profit really is a vanity metric. Ultimately, you're a business, you're trying to build a profitable business. Obviously, there are other things that matter. I'm not saying everyone's in it just purely for money. But ultimately, there are sort of a couple things that really matter. And when you think, oh, no, that doesn't matter, because there are all these things like WeWork, right? Like they have all these other, that's normally a bad sign, right? So same thing. For example, if I email my LPs, let's say 2 years from now, and I say, hey, this happened, we invested in this great company, didn't work out, this. Every LP is like, well, what is the IRR? What is the what is the TPI? What is the DPI, right? The longer it takes to get to that number in the email, the worse that number probably is. And hopefully if I'm performing well, I can say, X, Y, Z, and then I can explain a little bit, right? And I think LPs would appreciate that. And ultimately, I have a good relationship with my LPs. And so obviously, first, you're not going to see that number. Normally it kind of has this kind of like curve to it, right? Because you sort of get the losers first, right? The winners take the longest, right? And so I've seen that, at least personally, in my angel portfolio. And so I think, I can just be upfront and they'll get it, right? And if they don't get it, I'm happy to explain to them. But I think it is like, you need a confidence to be as open and transparent as I happen to be. And that makes you stronger, in my opinion. It makes you face that.
Yeah. You're very well known for being open and transparent. I love that fact. I would love to know your take on, like, you're investing in early stage companies, how important it is to design a path to monetization in product architecture.
I think it's super important. Yeah. I mean, I think there, ultimately, again, it is sort of why, it's how you continue to do what you're doing, right? You can raise money. Obviously, I'm a VC, so I would, I hope that startups do raise money. But ultimately, like, if you want to be a self-sufficient business, which every business eventually should want to do, depending on, sort of they can make a decision on when and how and et cetera. But ultimately, yeah, I think it's the thing that lets you control your own destiny, right? And continue to operate without having to rely on someone like me giving you money, right? Which you never want to rely on that. Gumroad, we almost had to rely on that, and then we got profitable. And, that story is kind of public as well. So I think it's important. And I think actually the founders who are thinking about that early, it's normally a good sign, because it normally shows me like a level of emotional maturity where they're already thinking about it, even though they might not be implementing it, but they have an idea around this is the way the whole thing completes. If you're only thinking about sort of like the next year or like what the product looks like today, and you're not really mapping out, like when you hear Elon talk about Tesla, right? Even from when I first invested in Tesla, it was a $2 billion company. It was a public company. Anyone could have done this. But I did. And the reason I did is because I saw, I read a post that he wrote, I think, that was like this sort of 10-year master plan or whatever in 2010, I think it was. And you know, he really outlined like this is the future of the company. It's going to take, you know, 10, 20, I don't know how long you said years, but we're going to start with the Roadster, right? It's the only car they have. It's, you know, and then that's going to let us do this, and that's going to let us do this, and that's going to let us do this. And when I see founders able to do similar things, Airbnb did this, I think, in the early days. If you go find their deck, I would have liked to say that I would have invested if I was an investor at that point. But you know, it shows like a level of discipline around the founders and their thinking that I think is sometimes lacking. Often I don't see that, and when I don't see that, I'm often saying, you know, it's not a fit for me as an investor.
Yeah, your story as a VC is like you started this after you saw the George Floyd movement. So I'd love to know what's your take on diversity. You know, is it a part of your investment thesis mandate?
Yeah, it's interesting because that is how the fund started. Yeah, it's a really weird, and sometimes it feels it is weird that that's kind of part of the origin story, but it's true. That's without that moment, it wouldn't have happened. Without a lot of different other moments too, right? It's kind of the culmination of many things. The way I think about it is, look, like I really believe that if you optimize for good returns, you will lead to diverse founders and vice versa. Like I think actually one of my superpowers and one of the big things when I would talk to LPs, and I hope that that's one of the, I know for sure that's true of many LPs. One of the reasons they got excited was the fact that I have Twitter. I have this massive megaphone where I can reach people that are very outside the traditional sort of startup Silicon Valley ecosystem. So I can find people, and it's honestly the best feeling. This happened to me yesterday, I think, where I DM'd a founder that I found. They followed me on Twitter, so I already have a signal that they kind of know who I am. And I was like, hey, you know, this looks really cool. What do you know, have you thought about raising money or doing any of this stuff? No pressure. And they're like, no, we haven't thought about raising money, but like, you know, we like you, we like Gumroad, we've used Gumroad for customers, like, you know, we'd love to talk about this a little bit more and learn. And, you know, I got an email pretty shortly after that meeting being like, you know, we'd love for you to be the first check. And that is the best feeling in the world, you know, because I can be the first check, which is great for me as an investor. And then I can add a ton of value because I can just connect them to a bunch of other investors. I can really help them basically save months of work and time and learning and being like, this is how you raise your seed round. These are the people to talk to. You know, this is, you know, here's some feedback on the deck. Like the leverage there is so high for me. So it's like, I feel like it's a win-win-win. And these are people that I don't know if they would have ever entered the traditional startup ecosystem or what have you, but like, I feel like I can connect those dots and create value in the process. And I hope that sort of means that like the people I invest in are going to be more sort of the underrepresented groups, right? Of course, I will say like a lot of the people I invest in will not be true, right? Because ultimately I don't have like a mandate that I don't invest in like white dudes in my network. Like I'm sure I will, and I have, and I will continue to, but like, I hope that is not like the vast majority, right? I have VC friends that they're proud of the fact that there's no website, there's no email, there's like, you know, and I'm like, that's just, everyone has their own strategy. I don't want to critique. It's not really my style to sort of say people are doing it right or wrong, but like in my view, I think it's a competitive advantage that I want to embrace, the fact that I'm so open and accessible, and, you know, I will answer, or I won't answer. I wish I could answer, but I read every single cold outreach I get, which is, you know, hundreds a week probably.
Yeah, amazing. So tell me a little bit further more about your investment theses, like what kind of signals you're seeing in the market, especially with COVID-19. Do you think, like a lot of people are talking about death of old economy, there's a new economies rising and different kind of market behavior, social behavior. We talked a little bit about free economy, and, you know, we are seeing there's a huge gap happening, you know, when it comes to wealth. And again, there's a lot of money in the private market. So, so how do you think your investment plays into this?
Yeah, I mean, one of the sort of my big Gumroad, I think, falls into this thesis is just like, I believe things will just consistently get easier and more accessible for everybody. Even rolling funds, I think, falls into this. I got my start because I grew up in Singapore, and I got my start because the Apple, the iPhone at that point, the iPhone App Store allowed me to like make apps and charge money to strangers on the internet, and Apple dealt with all the stuff, right? Effectively, I was running a business, but I could just be a developer, which is kind of like what now people say creators are, right?
Yeah.
And so I feel like for now, almost 10, 15 years, I've been kind of in that. And so anytime I see something that makes something easier, cheaper, faster, simpler, more accessible to more people, I get excited about that. And so that's sort of like one of the big pictures. I really believe in a future where there's basically a single market, where it doesn't matter who you are, where you are, how old you are. If you can create stuff and you can sell it to anybody else, and everything else is sort of painless, right? And that we're not there right now. We have a long way to go. For example, if you wanted to invest in Notion, you couldn't do it. There's some pain involved. You can't. And so I think all of this stuff, the private markets will get more and more liquid over time. Anytime I see sort of like opportunity to increase liquidity, increase competition, increase sort of the free market, I in general think that's sort of a good thing. And then in regards to COVID, I think it is sort of an equalizing force. Everyone is on their phone or their laptop talking to a screen. And I think that sucks for people who have a nice office on Sandhill Road, right? That they're still paying money for, but it's really great for everybody else. And so I really believe in sort of a lot of those sort of trends around future work and I think housing, I think transportation, I think food, I think infrastructure. I think there's a lot of really interesting changes that are going to happen because people are having to reconsider the way that they work and live. And those are broad, right? Working and living is kind of all we do. But yeah, I'm sort of pretty, and I guess that's the last point is like, I don't really have a thesis. I want to invest super early. I really care about the founders. But ultimately, like, I think I just think I'm not that sort of educated about the vast majority of things. There's only so many things that I feel like I know deeply. And so when I meet a founder and they're able to kind of educate me on the problem and then tell me the solution, that's always like a phenomenal sign, because it shows me that these people might be the right people to solve this problem. And they probably know so much more about it than anybody else, So that's when I met John from Stripe back in 2010, Gumroad launched actually before Stripe. We were one of the first users. Just the way that he taught about payments, like I would learn so much. And that was a really positive sign, I think, in terms of like how much impact they were able to have because they sort of intimately knew this industry better than virtually anyone under the age of 30.
I love that. And since we are talking about the blurred line between work and life, I mean, so venture capital it's not a job. I consider it's almost a lifestyle. And now you have two things, like one, you're a venture capitalist and you're also a founder. So how are you preparing for such a lifestyle? And would love to know, how do you analyze like various thinking models? You touched upon this a little bit. And how are you maintaining the work-life balance, especially with two jobs in hand? And also being a part of so many webinars and answering every emails as possible.
Yeah, it's, I think I can do it because I love doing it. It doesn't feel like work. I had a night off on, I think it was Monday or last week. And I was like, I had 3 hours. What do I want to do? And I, built some software for my new fund to help me deal with incoming cold stuff, which just to enable transparency in the industry. And for people can apply and then they can see how long it takes to get an answer back and get some transparency into that and how many steps there are in the process and kind of hope that it helps me kind of scale up my process. And I just love it, honestly. Like, I just think it's super fun. When I lived in San Francisco, I did the math and I met 7,000 to 8,000 people one-on-one for coffee over an hour. Like, no joke, no exaggeration, maybe conservative. Like, I really just enjoy doing it. I didn't really realize how much that was a fit for maybe being a venture capitalist, but I just love meeting people. I love helping people. I love learning about stuff. I'm not an extrovert, but I love meeting people one-on-one. And I just like humans. I think sort of figuring that out is really interesting. And ultimately, the reason I believe I can do this, when you talk to a founder, when I talk to a founder, I often ask, like, what's the hypothesis here? What are the things that you need to try to prove right or wrong that you need to be right for this thing to work, right? What are those things? How do we get to the answer as soon as possible so we don't waste time if we happen to be wrong on those assumptions? And one of the assumptions I have for this fund is that it's not time-based, that it's not like I need to work this, the more I work, the higher the returns are. I kind of think it's the opposite. When you kind of get obsessive about diligence and doing all this customer research, like that actually hurts you. I think you end up passing more than you should. And like, I think it is a gut intuition thing ultimately. And I have, tens of thousands of hours of running a company and meeting founders, and seeing where they went, like the Stripe founders and other folks. And so I have a pretty good mental model, and it doesn't take, it doesn't take 30 hours to decide if I should invest in a founder. It takes roughly an hour, 2 hours. Honestly, sometimes 5 minutes. I'll meet someone, and within 5 minutes, I'm in. I don't tell them that I'm in because I want to have an interesting conversation for a while. But sometimes sometimes genuinely I'll see their tweets because they'll DM me, so I'll like see their tweets, I'll see their deck, and I've already decided if I'm an investor. That happens quite frequently actually. Because I just see enough signs that I'm like, yes, they're thinking about these things the right way. Are they going to be successful? Who knows? There's so many things that can happen, but sort of in all the things that matter in terms of where you can figure things out early, I think, they're just like they're checking all the boxes for me. And so, yeah, I think it's sort of, I believe I can do both of those jobs. I believe, obviously Gumroad, one of the sort of unique things about it, ironically, is that it's a profitable, sustainable company. So it allows me to, it's 9 years old. I have a team that's great. It has a positive brand. It's growing.
Yeah, I think you got paused. So if you were saying it's a positive, successful company, and you can start again.
Yeah, Gumroad is a profitable, sustainable company. It's 9 years old. It's growing steadily. We have a great team in place. A lot of them have worked on the product for years. And so, I don't need to be there 20, 30, 40, 50 hours a week, making sure, there's not fires all the time.
Yeah.
It's not a startup in that early stage anymore. So I think that also affords me the ability to spend time on other things. And the team's excited about it, frankly, because it means that they have more autonomy. They have more freedom. They have more decision-making ability, when I'm not like, looking over their shoulder being like, what's up? Obviously I don't do that because COVID, but you know what I mean?
Yeah, absolutely. I love this discussion, and I think I wish there are more LPs coming to your fund. And I think after this interview, obviously there will be a lot of institutional LPs who will be looking forward to, okay, what's this rolling fund? And they may roll up their sleeves to write some checks. So thanks a lot, Sahil, for your time. And I'm super excited to have you and cannot wait for this to be published.
Thank you. Thanks so much for having me.
Great.